Hey everyone, thank you so much for joining. It's our first live stream, Market Live for the non-farm payrolls report, which is of course one of the biggest data releases of the whole month. This week seems to be taking a little bit more significance. We've had a lot of volatility in financial markets, particularly in the pound, in the Forex market, also in the bond market, of course. I'm sure you've read lots about that, but I think that's really what's driving it. But looking back to payrolls, we're expecting 165,000 for the key number. So that is what's expected. That's what analysts expect as along with from Bloomberg. This would be the lowest rate since August. That's if we remove the October data, because that was a bit of a strange number because of hurricane and weather-related disruptions. Most jobs have been coming from education and social care, and we can see that in chart 1 now. This shows us the last few years of payrolls, monthly payrolls growth. As you can see, we're down from the peak, but we have been ticking higher. So it shows a resilient labor market in the US. Now that has an impact on markets in different ways, because not only have we got payrolls, but we've also got wage data. Now I want to show you the second chart, which is wage data. So this is average annual earnings. You can just about see that there. I'm sorry, it's a blue line, but this goes back all the way to 2015. So it's a very long-term chart. We've seen a lot of volatility in earnings, spike higher in 2020 before they kind of came off a little bit as well. But overall, you just need to look on the right-hand side. That shows that earnings also ticking higher. Earnings ticking higher on a month-by-month basis. So we could have a resilient labor market and strong inflation. That could reduce the chance of rate hikes from rate cuts from the Federal Reserve. So right now, we are expecting payrolls to moderate slightly. However, we are also expecting wage growth to remain strong, so to remain at a 4% annual rate. Now, we've got 3 minutes before the non-farm payrolls report, and I just want to show you the third chart. The third chart is sterling, and it also shows you the spread between UK and US yields. That's the orange line in this chart. Sterling, or the cable rate, so the pound versus the US dollar, that is the white line on this chart. Now, the pound has made a multi-month low, multi-year low as we lead up to this payrolls report. It's been under a lot of pressure in recent months. We've also seen this spread between US and UK yields rise, as UK yields have been rising at a very fast pace. So interestingly enough, this payrolls report could have a big impact on the pound. If we get a strong reading, we expect a stronger dollar. If we get that, would weigh on the pound. It could also weigh on the euro, and it could put more upward pressure on bond yields. Remember, we've seen bond yields move inverse to price. That could trigger another surge higher in UK bond yields. But the other thing to note is that there's been a mixed impact on stock markets from payrolls reports. Higher payrolls reports can mean higher interest rates for longer. That's bad for stocks. So hence why we haven't necessarily seen a clear reaction or clear trend in the S&P 500 in the aftermath of payrolls reports, whereas over the last 12 months, it has tended to be strong for the dollar. So that's something certainly to watch there. Now, we've got about a minute and a half before the payrolls report here. We have seen a huge amount of volatility, as I said, in Forex markets. So I think we really need to look at the Forex market. That really has been central. The other thing to note is that we have had the US markets were closed yesterday. So stock markets were closed yesterday for President Carter's funeral, and we are back on today. So there could be a little bit more activity than usual. But I think jobs growth certainly has been moderating from its peak. But really, this is the decider about whether or not what the Federal Reserve does next. If we see another resilient non-farm payrolls report in just under a minute, then we could see expectations for rate cuts be taken off the table. That's dollar positive. As I said, it could have mixed news for stock markets. If, however, we see something in line, maybe a little bit weaker, maybe if we see a little tick up in the unemployment rate, that's currently at 4.2%, and there's no change expected there, then that could also be worth watching. But I'm going to tell you what these numbers are as they come out. We've got 30 seconds now. As I said, leading up to this, we've seen the dollar actually taper off. We've seen stocks come under a very small amount of pressure in the lead up to this. But really, it's because markets just want to wait for these numbers and they are going to react to them. So there is expectations of a big reaction to today's numbers, largely because we've got so much uncertainty in financial markets. We've started the market off the year off in a very volatile fashion. So we're going to wait just a few seconds now, getting the numbers out, and I'll tell you what they are. Just waiting. Okay, much bigger than expected payrolls number, 256,000 for December. We have seen, however, average hourly earnings on an annual basis, that's ticked lower to 3.9%. We've seen a slight reduction in the December figure and a decrease in the unemployment rate to 4.1% from 4.2%. So this is a strong report here. The immediate impact can be seen in the dollar. Let me just take a quick look. Remember, as I mentioned, the dollar had been moderating. Bear with me here as I just pull up my chart because we're doing everything live. The dollar had been moderating. It's really quite static around that 109 level for the dollar index. Not necessarily good news for the euro, which has really fallen sharply. It's fallen over nearly 50 pips now. It's down at 102.40 and it's falling very, very sharply. It looks like it's fallen off a cliff edge. Same with cable, now trading down at 122.16. In terms of bonds, we've seen a spike higher in UK bond yields, 7.5 increase in the 10-year yield, 7.8 for the United States and the 10-year Treasury yield. So again, we're seeing this pressure, upward pressure on UK bond yields, the same way that we see it. They're tracking the US yields very, very closely. So this stronger than expected payrolls report, as I mentioned just a few minutes ago, it's bad news for the UK fiscal position because it's putting more upward pressure on our bond yields because they're moving in lockstep pretty much with Treasury yields. Now, elsewhere, we obviously want to see what stocks are doing as well. Remember, US stocks aren't actually open so we're trading on the E-minis. They're still lower, and we're the interesting stat, we've seen the US economy add jobs for the 48th straight month. That must be one of the longest running streaks. But we have seen a decrease in the futures market for the S&P 500. That is down currently 0.26%. So not a massive decline in stocks, but definitely leaving us room to consider what the Fed will do next. This is a very resilient labour market, that is for sure. In terms of interest rate expectations, well, we've seen a reduction in rate cut expectations on the back of this, totally expected. Now there's only a 33% chance of a cut in March. I think we've probably gone well below 50% chance of a rate cut by May. That was when the market had about a 50-50 expectation for a cut yesterday ahead of this report. So that's now been priced out. So again, we are pricing out interest rate expectations from the Federal Reserve. This is putting upward pressure on the US dollar. And we have weaker stocks. So this is, again, the trend has continued. We've got this very strong labour market report yet again for another month. We will write a report up on it with all of the extra detail. But I think it's really something to note that this is a very strong report, so it does show a lot of resilience in the US economy. Now, we had pointed this out in our preview yesterday. We said that economic growth in the US is expected to remain strong. The Atlanta GDP now expectation for GDP in the US is 2.9% for Q4 on an annualized basis. That is so much stronger than what growth we're seeing in China, than growth we're seeing in Europe and in the UK. Obviously, China as well, having its growth wobbles. So the US is very much an outlier here, and that's having a huge impact on financial markets. So we've seen, again, I'll just take another quick look at the euro. Yeah, so the euro is extending its decline now. It's back below 102.40. I mean, it really is. It's falling like a stone in front of my eyes here. I'm looking at cable as well. Oh, we've just gone below 122. So we're really breaching these lows. In terms of cable, so that's the sterling US dollar rate, we are literally seeing the lowest level since, just bear with me, I'm just pulling up my longer term chart. We're looking at the lowest level now from 2023. There's key support at around, obviously 120 is the key level, and then about 118, which was the low from 2023, from August 2023. So we've got 120 really looks like it could be in on the cards right now, but we certainly have got a very strong dollar, resurgent dollar. It had weakened into this report and it's now really hitting it hard. That's going to weigh on stock markets and weigh on risk sentiment. Also, that spike higher in bond yields as well. Not just a problem for the US, a big problem for the Labour government here in the UK and for the UK's fiscal position. That weaker UK pound, rising rising bond yields, that's a really bad toxic mix. It could push us closer to some sort of fiscal event, some sort of intervention. I'm sure the Bank of England is watching very closely. I'm sure that Rachel Reeves is as well. But thank you so much for joining. We really appreciate it.